Johannesburg.
When making investments, there are 4 key risks to understand and be aware of, which, if managed correctly, should help you to avoid permanent loss of capital. In our personal finance feature today, we're joined by John Kennedy from Citadel Investment Services, who's going to help us understand those key risks. John, thanks for your time this evening. I think let's go straight into it. And the first one is integrity risk, which is really about not choosing the wrong partner, I suppose, or making the wrong investment choice.
Absolutely, Siki. It's great to be on your show. I think just quickly as context, I think everything about your show and all the media at the moment is causing us to worry.
Yeah.
There's certainly a wall of worry out there at the moment, and investors are scrambling a little bit, and people are in protect mode. And with all the emotion at the moment, I am concerned, and we as Citadel are concerned that people are going to make some fundamental errors. So the first thing is that when times are tough, when people are feeling vulnerable, when people are feeling anxious, they typically chase dreams or chase unrealistic returns. There are numerous products out there which are sometimes just too good to be true. And so when I refer to integrity risk, I say choose the partners, the institution and the advisor that you work with carefully. Make sure that you understand them, that they have a track record, that they are well regulated under the guidance of our regulator, etc., because it's a critical part of protecting your capital.
And that takes doing your homework, I suppose, looking around, ensuring that you ask the right questions as well.
Absolutely, and I think the right questions are asking for references. If you're going to work with an institution or an advisor for the long term, you want to make sure that they have a client base that is similar to yourself, similar profile. And there's nothing wrong with doing some investigative work and finding out who the clients are and being open and having conversations with those clients. I think it's an important part of ultimately protecting your capital.
The other concern is that, of course, at times when people are desperate, they do go for these, they believe they get rich quick schemes. And one of the fundamental pieces of advice that I've ever received was, if it sounds too good to be true, it probably is. How do you avoid falling for those?
Well, I think just use your words. If it sounds too good to be true, it is most likely true. And that is often the promise of an unrealistic return or something far better that you can get elsewhere. And if we understand the market will reprice something that offers an unrealistic return. And so people chase these dreams because they're trying to fill a void, or they're trying to play catch-up, or they've incurred a loss somewhere, and they're desperate. And particularly in the current environment, with all the news that we are being bombarded with all the time, because the tide is going out. If it is too good to be true, do your research, chat to people that you respect and trust, and get them to advise you accordingly.
Let's talk about the second one, inflation risk. How do you manage that?
Well, my concern in the current environment, Siki, is that because we're so nervous, we typically default to cash. We think we should sell out of everything and put all our money in cash. And we think we're safe there. Unfortunately, with inflation running north of 5%, and looking at what you can get on cash, you typically, after tax, end up with a negative real return. And if you compound a negative real return for long enough, your purchasing power is eroded, where at the end of the day, you can't catch up.
Yeah.
And so having too much cash and not beating inflation by a meaningful margin over time is a permanent destruction of capital.
The third one is credit risk. What does that refer to? Or counterparty risk?
Okay, so what we're hearing about at the moment is that in South Africa in particular, we're in a rising interest rate environment.
Yeah.
What that means is that the cost of money is increasing all the time. And we as investors lend our money to different parties, whether it's governments, it's parastatals, it's corporates, it might be to a friend. And in a rising interest rate environment, the credit risk, the risk that counterparty of who I lend my money to, unable to fulfill the terms that we agree on and pay us the interest or the income, or the capital back at a predetermined date, that is at risk. And we've seen it. We saw it last year with Edcon debt, where we were forced to see a haircut on those bonds. We saw it with Greece being unable to repay their debt. And one's just got to be careful, because in every investment portfolio there is credit risk.
Yeah. So let's talk about valuation risk, which is then the fourth one. And this one, we deal with stock markets and equities all the time. And there's many different ways to value a stock, for example. So how do you manage valuation risk then?
So valuations really mean that at the end of the day, what we see and what we talk about is prices, what we see in financial markets on a day-to-day basis. And those prices are not always reflective of underlying values or the intrinsic earnings. What happens when times are good is we typically overpay for an investment. And when times are tough, as we see in the current environment, the prices don't necessarily reflect the intrinsic value. The risk is at the moment is that we sell out of something because we just capitulate. We just think that it's enough. We want to get out of this investment. We'll go into cash. And we lock in that loss. And locking in that loss is a permanent destruction of capital. I'd like to assume that many investors have gone into an investment being well planned and thought through, and that they've allocated sufficient time for the investment, that they don't have to capitulate. But if you capitulate in this current environment where you sell certain investments that are priced below intrinsic value, that is a permanent loss of capital.
All right. Thanks for the advice. We'll leave it there. Thanks for your time today. John Kennedy is with Citadel Investment Services. Fact of the day coming up after the break. Stay with us.